Hello, this is the Chart Profit webcast. We have just about 2 hours left before the close on Friday the 18th of September. This from the pre-open. We're looking at the E-mini S&P. Quick recap. We recently saw, actually the start of this week, the minor point of control migrate up to here, 1954. The following day we found support at that level. I said it could be support or resistance intraday on Tuesday, and it was certainly support. We saw a strong day on Tuesday with aggressive buying marked, and we had a probe there above or into the first level at the time, resistance 1978.50. That's the half range of this year's high. So this level was resistance. The following day we overcame that resistance again, marked aggressive buying up here. In the short term, these green at top highs are exceeded the following day 80% of the time. They're relatively bullish in the really short term, so we've seen higher again on Thursday, yesterday, and I said this morning that if the E-mini holds above 1978.50, the major half range support, which is here, then it's in a strong price location. But with Thursday's spike up to 2020 and the strong rejection at that level, I said there's a high chance that the E-mini will want to test back down to 1954 down here. And then I said that should that occur, subsequent price action, and especially if the point of control migrates, will give us a clue to the next directional move. So let's look at that on the chart. So here we are with the E-mini. I'm looking at daily chart here, and here's 1954, and we have declined today to almost test this level. I think it's quite likely the E-mini will print down there, print some time, or find support here. There's a bit of a look about this distribution. I'm not actually showing you the price distribution chart, but it looks very familiar to me. This rejection up here is an indication that we're at the extremes of the distribution up here. So I think we're looking at a typical distribution shape here. So I'm expecting that we'll print back to the controlling price of the distribution in here. And from there, it depends what happens. We may see immediate support and then the market rally, and we'll see a new distribution with an upward bias, or we'll see some time spent here. The point of control might migrate slightly up or down. That will give us a big clue. So going into next week, if we see price back above that halfway off the high here, which comes in here at 1978.50, we see price back above there now. I'd say that would be a pretty bullish development, and we probably see breakout higher. But we're still waiting for the breadth to improve, price momentum to turn positive. I wouldn't be at all surprised to see some more time around here, but we'll let the market tell us what it's going to do early next week. So just looking at the pulse chart, and we can see the breadth in the middle here. This indication, if that's red, the breadth, or our daily breadth indicators are negative and not supportive, and that's still where we are, and that's been the case since late May back over here. Price momentum is heading higher. It could very easily turn positive here, but it hasn't quite yet. And if we look at the market charts, the color study on the top here on these weekly bars as of last week, pretty solidly red from, again, actually middle May at this point, and for the Nasdaq as well. And on the daily breadth indications through yesterday, Thursday, these two bottom indicators, as you know, we like to see them above those middle lines, but currently for New York we have both just below, certainly this one, percentage stocks greater than their 50-day moving average, around 30. I see that above 50, pretty much the same with the Nasdaq. So breadth could certainly improve. So a quick review of the stock index ETFs. This is the spider, just coming up to the Fed announcement this week. Things were looking a bit stronger as we probed above the halfway point here, but you can see that's been pretty firmly rejected. Just look at, just zoomed in there on from the start of September, just looking at a moving average area of the close, or a line chart of the close on a bar. Pretty much you can see that more or less the trend has been up through September, up to the 17th, possibly we're changing here with this big rejection. It does look pretty much like the averaged September from a 5-year, where we start beginning of September, we rally through to about 17th, 18th. 19th, and we're pretty flat usually for the rest of the month. But in market that's been very volatile over the last couple of months with some really strong downside price action, see any weakness on this decade cycle like we have here, and you should be a bit cautious, especially if we are printing back below these halfway points. So that's the spider, that's the Russell 2000 ETF IWM. The level that we've really been watching is 116, which is the major point of control, and was resistance here and here. But actually the halfway point from the high comes in here, and that's where we found resistance yesterday on the spike up. Price back below 116 again obviously is weakened price location. So the Dow diamonds looks pretty similar. See, the US markets are actually the outperformers, or relatively the strongest. This is the FTSE 100 UK large cap index. It's retraced about a third here of the decline, whereas the S&P has retraced about a half. This is a major level down here for the FTSE at 58.70, and we saw a probe on the big decline in August, but we're printing back above that level. Price down here for the FTSE would be really bad news for that market, I think. And interestingly, like the US, this is the UK mid-cap index. So like the Russell that we just saw, we've seen that halfway retracement, and that's where we found resistance. A lot of people calling Europe higher and relatively strong, but we don't see it in the charts for various reasons. Europe, Japan, with QE expected to outperform, just not seeing that. So the DAX, this is German DAX, had a really weak close today, quite strongly down. Here's the Nikkei as well, currently printing here below the 25% retracement of the decline. So not much of a bounce yet. Not showing all the sentiment charts today. They'll be in the ebook on Monday, but one we ought to look at is the Lipper US fund flows. They reported equity fund, including ETF. That's a net weekly inflow of 12.7 billion. This information here is wrong. We had a net inflow of 12.7 billion this week, and that is the largest single weekly inflow in 10 weeks. And if you remember, last week we had a huge outflow, about 16 billion. But this data telling us that a lot of money here flowed back into the funds. 4-week flow is at a negative 17.4 billion. So over 4 weeks there's a net outflow. That's the yellow line here, and it's up from this level, which was at a negative 30.38 billion. That was the lowest since February 2008 down here. So we had a bit of a bounce back, but last week's 4-week flow was an extreme number down here. These are contrarian indicators. Just thought it was interesting that data showed quite a large net inflow this week. Okay, after the Fed announced no change yesterday, we saw a rally in TLT, the T-bond ETF. To here, we're higher today. We've spiked higher above the 12-month point of control. So bonds coming back into a stronger position here. Oil, this is the US oil fund, USO, closing or looking to close weekly at the end of the week here. Mentioned in the pre-open, found support. This low always marked a half range off a new low to the subsequent high, and you often get support here, which we did here. Price below here would indicate or suggest a retest of the low. GLD, the gold trust ETF, having a good week, up quite strong. Okay, last week we talked at length about the dollar and potentially how I thought, and from the charts, how we could see the possibility of some weakness for the dollar going forward. We looked at this retracement here from the high back in March, and we said that that was an obvious point of resistance, and that proved itself there. And then we were looking at this point of control, 12-month at 95.22, and it's a price below that level would be weaker, but various charts supported the possibility of the idea of a weaker dollar going forward, and we see the dollar index quite a bit lower and below that 12-month point of control at the end of this week in a weaker price location. So this may develop. and therefore we were looking at the Euro FX chart and saying that potentially I could see the euro gaining strength over the dollar. This blue line is a major half range going back to the 1980s. So price above that level puts it in a strong position, and in the more recent price action we've seen a 12-month point of control develop at 113.40, which is here, and we may well finish the week so above that level. So if we see some time above there early next week, that increases the odds of strength developing for the euro, and again possibility of weakness for the dollar. The Aussie dollar's come back a bit this week as well against the dollar. It can't work itself into a strong price location until it gets back above here, above spot 760, which is the major point of control, but I feel this may be a low here. Dollar yen, from this high to this low, halfway point. Again, call it natural resistance, that's what we've seen here. But if we see price next week below this 12-month at 119.64 down here, we'll probably see a retest. So there's a little bit of mounting evidence that this weakness for the dollar could play out here. And I did show this hourly chart, now updated from the start of July, for dollar index in black and the E-mini S&P in red, and we looked at the correlation there. So we have the stock market looking like it's in a weaker price location at the end of this week, failing at important levels, and possibility of a correlated weaker dollar index. Okay, that concludes the levels, or most of the levels I've shown you will be in the ebook on Monday. I wish you a good weekend, and once again, I thank you for watching.